Imagine this. You wake up, check your accounts, and your life savings have just vanished. Well, for thousands of silver investors, that nightmare became brutally real on January 30th, 2026. This is the story of silver's Black Friday, and we're about to break down exactly how it all went so wrong so fast.
I mean, just hours before the collapse, silver was the hottest ticket in town. It had just rocketed to a new all-time high of $121 an ounce. The market wasn't just happy, it was a full-blown inferno of greed, with everyone telling stories of cashing in big.
But in less than 6 hours of trading, that inferno was completely doused by a tidal wave of selling. And that all-time high, it instantly became a very distant, very painful memory. By the middle of the afternoon, the price had completely cratered, all the way down to just $76. That's a 33% wipeout. And for so many families, that number meant everything. Lost homes, shattered retirement plans, a future that suddenly looked a whole lot darker.
So what on earth just happened? How could an asset with such a perfect story, such momentum, just completely fall apart in a matter of hours? That's what we're going to unravel right here, right now.
So, let's start by looking at the event itself. This wasn't just a correction or a bad day. No, this was a brutal wake-up call about the hidden dangers of betting with borrowed money.
To really understand the crash, you have to first understand the insane rally that came right before it. You just can't have a train wreck of this size without a speeding train. And believe me, this thing was going 1,000 miles an hour.
And wow, this chart, it just says it all, doesn't it? In the 12 months leading up to the crash, silver put on a staggering 332%. Now, compare that to the S&P 500's gain of 20%, which, by the way, is a great year. This was a classic textbook case of FOMO, the fear of missing out, and it was about to have some devastating consequences.
Now, here's what made this so tricky. On the surface, this rally looked like it was built on a rock-solid foundation. You had this classic supply and demand squeeze, right? Industrial demand from things like solar and AI was just exploding, while at the same time China was hoarding its own supply. And then, to top it all off, you had the Fed basically pouring gasoline on the fire with cheap money. It was the perfect storm for a speculative bubble.
So, the most important part is that there was this simple, powerful story that everyone could get behind. The story was easy. Silver's the new gold, it's scarce, and it's going to the moon. It made sense. And for a little while there, it looked like they were absolutely right.
All right, let's look at how this all came tumbling down. Because with so much speculation, so much borrowed money in the system, the entire market had basically become a house of cards. All it needed was one little gust of wind to blow the whole thing over.
And there it was, that gust of wind. An unexpected announcement that President Trump was planning to nominate Kevin Warsh as the next Fed chairman. Now, Warsh is known as a hawk. What that means in simple terms is he's the kind of guy who takes away the punch bowl right when the party's getting good. The market heard that news and immediately knew the era of easy money was coming to an end.
The Warsh news was the trigger, sure, but the real weapon of mass destruction here was something called a margin call. The best way to think about it is like this. Imagine you're at a casino and you're betting with the house's money. If you start losing big, the casino's going to come to you and demand you pay them back right now. If you can't, they take whatever chips you have left and throw you out. That's a margin call.
And that's what created this catastrophic death spiral. See, the first price drop from the Warsh news, it triggered margin calls. A lot of traders couldn't pay up. So the brokers started force selling their silver to cover the debts. This flood of selling made the price nosedive, which, you guessed it, triggered even more margin calls, and the cycle just kept repeating, feeding on itself all the way down.
So when the smoke cleared, who came out on top and who got absolutely crushed? Well, the big winners were the commercial shorts. We're talking hedge funds and big banks who had bet that the price would fall. And the losers? Pretty much anyone who was long silver with leverage, from the smallest retail trader who got caught up in the hype all the way to the big funds who just got caught on the wrong side of the trade.
Now, if this whole story of a speculative bubble, a ton of leverage, and then a sudden violent crash sounds a little familiar, well, that's because it is. When it comes to silver, we have definitely seen this movie before.
Just take a look at this timeline. The 2026 crash fits right into a pattern. You've got 1980s Silver Thursday, the 2011 crash, and now this one. And the common thread, the thing that ties all of them together, isn't just leverage. It's a sudden change in the rules of the game that catches all the leverage players completely off guard.
And this comparison here is just striking.
We're talking about different decades, different people involved, different catalysts that set it all off. But the result, the mechanism, it's the exact same every single time. A leveraged rally followed by a forced liquidation cascade. It's the oldest story in financial markets.
So, after sifting through all the wreckage of this crash, what can we actually learn from it? What are the real painful takeaways here? Okay, this is probably the single most important lesson of the whole thing. There is a world of difference between owning physical silver, I'm talking actual bars and coins in your hand, and trading paper silver, like futures contracts. With physical, you have zero leverage, which means no one can ever force you to sell in a panic. You just ride out the storm. But with paper silver, that high leverage means one margin call can completely wipe you out, instantly.
And that's the ultimate risk, isn't it? It's not just about taking a loss, it's about losing everything. A 100% loss. That's the price you can pay when you play with the fire of extreme leverage.
Which really brings us to the core lesson of this whole story. Forget the complicated charts and all the Wall Street jargon for a second. The real takeaway is this. Leverage is like a drug. It feels absolutely amazing on the way up, makes you feel like a genius, like you're invincible, but the crash, the hangover, it is always just around the corner, and it is always brutal.
So the next time you're tempted by one of those get-rich-quick stories, a hot stock, or a commodity that's guaranteed to go to the moon, just remember silver's Black Friday.